In this week's video, we'll review some very easy to understand charts that will help us answer the question, are stock market bears about to regain control? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index as of 1:55 p.m. on Friday, March 4th. At 1:55, the S&P 500 was up over 15 points, and we closed up 6 points. So we gave a lot of this back. We'll talk about the relevance of that a little bit later. We're going to ask some very, very simple questions about trends to help us understand and put this move in some proper context. What is the last major thing that occurred on this chart from a trend perspective? The S&P 500 made a lower low. Have we made a relevant higher high relative to our time frame? The answer is no. This is a lower high relative to this high. This is a lower high relative to this high. This is a lower high relative to this high. And this is a lower high relative to this high. And thus far, this is a lower high relative to this high. A fair question may be, but what about these higher highs here? Those are relevant, but not for our time frame. Well, how can you say that? Well, here's a relevant higher high here on this time frame, and notice what happened. The gains that followed were fully retraced. So this is a relevant higher high on a trading time frame, but on our time frame, the primary trend is still down, as seen by a series of lower highs. If we clear this level here, that would be a good first step, but the relevant levels are really all the way up around 2080. Next question, have we violated normal and to be expected Fibonacci retracement levels? Remember, the Fibonacci retracement levels help us with this question. This move, here's a drop from A to B. Normal retracements tend to retrace either 38.2% of the A to B move, 50%, or 61.8%. As you can see, we are still within the normal and to be expected retracement zone. No red flags here yet either. What about some common moving averages? Some logical questions might be, has the slope of the 200-day turned back up as a result of this rally? Has the slope of the 50-day turned back up as a result of this rally? Has the 50-day crossed back above the 200-day? As of 2:23 p.m. on Friday, March 4th, when the S&P was up 8, it closed up 6. The answer to all three questions is no. Slope of the 200-day remains down. Slope of the 50 is improving a little bit, but it's still down, and the 50-day remains below the 200-day. Notice during a strong bullish trend, typically the 50-day would be above a positive sloping or upward sloping 200-day. The slope is up, the slope is up, price is above. Slope is down, slope is down. Also notice this trend line here and the 61.8% retracement and the 200-day all come in somewhere in the neighborhood of 2023 to 2025. This is an area of possible resistance. If we clear this area here, there are 3 more potential hurdles above. Something else that was noteworthy, remember midday we were up 15 and change. This is the close. We closed up 6 and change. This is an indecisive doji look here on the daily candlestick for the S&P 500, and it occurred at the intersection of the 100-day moving average in green. All of this information that we've just covered, including the doji here, all of it just speaks to probabilities. But every one of these binary and logical questions is coming back with bearish answers that align with this being a counter trend. Is it possible that every single question that we've asked could flip over to bullish or yes? Absolutely, positively, yes. But the whole purpose of the model is we don't anticipate that. We wait for the evidence to improve, and we are open to the evidence improving, but we just haven't seen enough yet that tells us this is anything other than a normal and 100% to be expected counter trend rally within the context of an ongoing downtrend. Obviously, at some point in any downtrend, that will change, because we know at some point a new uptrend will start. And when it does, the hard data and the charts and the evidence won't miss it. When will that happen? We have no idea. We don't need to know that. It could happen next week. It could happen sometime in the next 3 weeks. It could happen 3 months from now, or it could happen at much lower levels 3 years from now. Just a friendly reminder about counter trend rallies and green days and realistic expectations when we wake up every day via Twitter. Bill Hester, CFA, here's his Twitter handle, reminding us that since 1930, in bear markets, the market is up 45% of all trading days, meaning roughly half of the days, trading days within the context of a downtrend, are green days. He also notes that the up percentage since the market peaked in May of last year aligns with history so far at 46%. Experience counts in the study of charts and using technical analysis. Peter Brandt via Twitter, February 29th. Trader of classical charting principles since 1980. That's the key. A lot of experience built into this tweet here. Peter says, I believe the S&P 500 is forming a major top. A rally into the 1990 to 210 zone would actually bring excellent balance to this top on a weekly chart. This is a daily chart, but regular viewers know that we've shown similar topping patterns in past videos. This pattern and this look, like everything else, simply speaks to probabilities. When we use the term probability, it tells us that good things and bad things can happen from any profile. Regular viewers and clients know that we've shown in the past that risk-on, risk-off ratios, similar to this one, SPY, relative to IEF, is the S&P 500 ETF relative to a 7 to 10 year Treasury ETF or an intermediate term Treasury ETF. This is stocks versus bonds, risk on versus risk off. As we've shown in the past, ratios like this will respond at bear market lows and bull market peaks. They're also very helpful during corrections and subsequent rallies. What can we learn from this ratio using the same analysis that we just performed on the S&P 500 chart? One thing we can learn, it can help us answer the question, how are defensive assets holding up relative to growth-oriented assets? What's the last major thing that happened from a trend perspective on this risk-on, risk-off ratio chart? The ratio made a clear and discernible lower low in February of this year, consistent with an ongoing downtrend. What about a higher high? Remember in last week's video, we said the model, the standards get higher, the thresholds get higher in a bear market because the primary trend now favors defensive assets until proven otherwise. Like the S&P 500, this chart has not made, from a trend perspective on our time frame, anything even remotely close to an important higher high. This is an important higher high relative to a trading time frame or a shorter term time frame. Notice a high very similar to this one here was made last year within the context of what is now an established downtrend. We didn't know that then. Now we have more evidence. Higher high, fully retraced. How about the fibs? Do we have any red flags or yellow flags on the retracements? We do not. The ratio is in the middle of the fibs. It's falling into the 100% normal and to be expected retracement within the context of an ongoing downtrend. The ongoing downtrend is in place until the facts say something else. How about the moving averages? Similar situation. The slope of the red 200-day is still down. The slope of the 50-day is still down. We do have some improvement. Price is above blue. Notice price went above blue here. Also notice the slope of the 50-day turned back up, and these gains were fully retraced, and the 200-day even started to turn back up. As noted in past videos, the model uses the 200-day and it uses the 50-day, but they do not carry heavy weights. We use these in the videos to illustrate basic concepts. Like the S&P 500 chart, everything that we've just talked about doesn't tell us when the trend will change from a primary downtrend back to a primary uptrend. What we do know and what we are confident about on the S&P 500 chart and on this chart, we do not have evidence in hand as of the close on Friday, March 4th, telling us that the primary trend has flipped from the existing trend of down to up. That absolutely, positively may happen, and it may happen as early as next week, but we haven't seen it from a hard evidence perspective yet. It's pretty easy to see that the look of this chart today looks quite a bit different than the look on this side prior to when the stock market peaked in May of 2015. A fair concern or fair question may be, after a very strong 3-week rally in the S&P 500, how can we still be in a primary downtrend after a rally of that magnitude? Well, keep in mind, we've seen in the dot-com bust one-day rallies, a single trading day, up almost 6%, up 5.4%, 5%. The top 40 single trading days, all for the most part, posted a greater than 2% gain. Also notice, all of these big green up days with impressive candles occurred within the context of a primary downtrend. Counter-trend rallies can last a long time, and they are 100% normal and to be expected. If a counter-trend rally lasts for 3 months or 6 months, then the model will start to make some moves. In fact, on Friday, we made a very small move. Why? The rules required it. You saw on the previous chart that price was above the 50-day moving average. We have seen some improvement, and the rules require us to start scaling back the other way. However, as we'll see later in this video, the only ETFs that are passing our scoring system and can clear our hurdles are still relatively defensive-oriented ETFs. More on that later. You may still counter with, but the gains off of the recent low have been really, really big. Well, this puts it in the proper context. There were single trading days within the context of this primary downtrend, not 3 weeks, a single day where the S&P 500 was up 11.58%, 10.79%, almost 7%, almost 7%, 6% plus, etc. The top 40, similar to the previous bear market, every single one of them for the most part was either a gain of 2% or greater, meaning we had very strong looking candlesticks on all 40 of these days most likely, and all of these gains, including single day gains over 10%, occurred within the context of a primary downtrend. Before we move to the next set of charts, let's talk a little bit about the ETF scoring system and what it's telling us and what we can learn about the bigger picture. The ETF scoring system has screens. ETFs must pass certain screens or we can't even consider buying them or adding them to the portfolio. These bulletized points here are the areas of the market or the sectors that are passing the screens. Bonds, some currencies, some ETFs related to precious metals, defensive equity sectors, and a handful of inverse stock ETFs. All of these align with a bear market profile, and none of the traditional equity-based ETFs are able to pass our screens yet. We have seen improvement on those screens, but they can't clear some of the minimal hurdles. That may change, but it hasn't changed yet. And by rule, we are not allowed to buy them yet. This list also aligns well with the S&P 500 chart that we just looked at. This quote here comes from the Felder Report. You can either Google Felder Report. Probably better to Google some of the text and the title of the article that it came from. This quote comes from a very, very successful investor. Again, someone with a lot of experience. Experience counts in the markets. Stan Druckenmiller. The quote, "Earnings don't move the overall market. It's the Federal Reserve Board. Focus on central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures. It's liquidity that moves markets." I've been doing this since 1994. I can't agree with this quote more wholeheartedly. This is 100% on the money. Friday's employment report is one of those conventional measures. Does that report move us closer to easy Fed policy or tighter Fed policy? We know the answer. It moves us closer to tightening financial conditions. And notice the title of the article. This quote and this concept, the greatest money manager alive attributes the majority of his success to just one thing, and that's liquidity. We're in a position now where instead of the Fed having the markets back, the Fed is trying to tighten policy. It's not the only factor here, but it's an incredibly important factor. And if the Fed puts off a rate increase, that's still not the same as lowering rates or printing money. The bias, especially with some of the new inflation readings, is for them to try to raise rates rather than lower them. That absolutely positively may change. But remember, a few weeks ago we showed with rates basically at zero, the Fed does not have many arrows left in their quiver. Another relevant point from an experienced market participant, quoting Bill Belichick, the New England Patriots coach, "The score is not important. Focus on the process." It's extremely important to continue to execute properly. That is the criteria that we should be keeping our eye on. The score and the results will take care of themselves over time if we're executing properly. And we have been executing properly. This is a difficult pattern and market. Topping patterns are difficult. There's a lot of confusion in here. As always, if we focus on the hard data, the charts, the risk on, risk off ratios, and the rules, the market will get us in the right place if we wake up every day with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.